Thank you for standing by and welcome to the Uscom Q4 FY20 4C Investor Webinar. All participants are in a listen-only mode. There will be a presentation followed by opportunity for questions from participants. Please type any questions into the panel on your screen and these will be placed in the queue for the Q&A session. Presenting on behalf of Uscom today, we have the Chairman and CEO, Professor Rob Phillips. The presentation today will last approximately 20 to 25 minutes with time for the Q&A session thereafter. I will now hand over to Rob. Please go ahead.
Thanks, Matt, and welcome to this 4C Q4 briefing for 2020. Uscom has delivered record growth in a rapidly shrinking commercial world. Medical technology is a cornerstone of health and investment, and Uscom continues to execute a targeted global strategy of growth and expansion. While the future is uncertain, China, Uscom's major market, is rebounding, and Uscom is expanding into Europe and the US. Uscom has life-saving devices in all the major global markets and a product pipeline to ensure revenue growth foreseeably. Uscom is becoming a global, vertically integrated medical technology leader. Uscom's mission is very straightforward. We're experts in circulation, and our vision is to improve clinical care in cardiovascular and pulmonary medicine and address the challenges of global disease. We've also got a driving commercial ambition to become a leader in global healthcare and establish a profitable and enduring growth culture. The results for the year released yesterday demonstrated record annual cash receipts, 4.6 mil up 36%, record at revenue and annual sales. The record annual net cash flow was up 2.07 million and we remain debt free. The record second half was the first profitable and cash flow positive half in Uscom's history. Record H2 cash receipts up 84% and sales up 64%. Record H2 receipts, revenue and sales were approximately the same in value as the full year results for 2019. Record Q4 cash receipts and record Q4 sales were also registered. If we look at this graphically, you can clearly see that there is a trend with record cash receipts and sale, upward growth trend, cash receipts of 4.6 million, up 36%, half two profitable, cash on hand and debt free. If we look at that in a little more detail, cash receipts up 26% as we said, profit up slightly, net cash flow up significantly, sales up significantly and cash receipts up. And this was in a very difficult trading circumstance. The half two results were outstanding. Record cash flow positive, profitable and record cash receipts. Cash receipts up 84%, sales and revenue up 62%, net cash flow up 1.47 million to 500,000 positive, and profit up 0.78 million for the period. The quarterly results were again record cash receipts and sales revenue, with net cash flow up again as a record, and our cash on hand was up 57%. The previous Q4, which we're comparing to period on period here, was our previous record. Additionally, for Q4, we sustained both FX losses and we spent considerably on inventory updating to manufacture devices for Q1 of 2021. If we talk about innovation, and Uscom is an innovative medical device company, we provide the best technologies, and spirometry is one of the very powerful things that we are invested in, and it's a medical technology which is applicable to home care, critical care, and telehealth. And it's from the use of this technology that we have developed the newest product in the Uscom suite, which is the VentiTest ventilator calibration technology. And it's a technology which will take us into a variety of clinical environments. The device has been accelerated to market in the last 6 weeks and is undergoing final testing and approvals. As the device is a non-medical device, the registration centres on safety measurements alone. So the timeline for Chinese, European and US approval is accelerated and maybe in the order of 6 weeks to market, which is very much different to the medical devices that we deal with day in and day out. We know there's been an explosion of ventilator acquisitions associated with the COVID pandemic. And almost all ventilators require daily calibration to ensure accurate and precise ventilation, and digital ultrasonic flow, pressure and volume calibration, as the VentiTest provides, is the most sensitive measure to ensure accuracy. Uscom has high fidelity multi-path ultrasonic technology, which is integrated into this. The ventilator calibration is potentially a significant market for Uscom's high-fidelity ultrasonic spirometry technology and can bring real revenue to the company. And we've experienced very high dealer interests in this technology, although it's still undergoing final testing and delivery. From a company point of view, the record results for Uscom for 2020 were delivered as we continue our expansion in a fast-growing global network of subsidiaries and offices, which provides us access to the world's largest markets and provide a natural product, currency, and geopolitical hedge, which is increasingly important. In the current rapidly shifting international business world, this diversification is a powerful risk mitigant for us and sets a platform of assured growth and revenue. So what are the growth revenues for 2021? Well, the China economy is rebounding, and Uscom, as measured by the China bull market at the moment, which is rebounding extremely rapidly. And Uscom China continues to grow both in number and quality of distribution as we build out our China distribution network and our new products become approved. In Europe, the US new distribution models are being, in Europe and the US, new distribution models are being implemented as pandemic conditions permit. Obviously, it's difficult doing businesses in these locations, but we are building out our distribution under a new model. Demand will be supplemented ongoing by upgrading and refurbishing of infectious diseases and centres worldwide, while new products, including the VentiTest and the VentiTest S, will be fed into our expanded distribution networks as regulatory approvals are received. So it's a pathway from where we are to where we're going. So what are the risks for this year? They remain focused on the pandemic and the slow recovery to normal business. However, China remains one of the least affected countries, with its manufacturing and consumer indexes showing positive growth for the last 2 months and infection rates approaching zero, as Uscom China is also experiencing increased activities. Regulatory approvals are increasingly becoming significant points of resistance, and while for Uscom's non-invasive technologies, the absolute risk of denial is minor, delays are routine and unpredictable, making planning for product releases and manufacturing difficult. Increasingly, regulation and compliance are becoming more invasive and expensive, and it's estimated that for Uscom alone, it costs nearly $500,000 PA to remain an Australian listed entity, and this cost is increasing annually. Just to revisit the Uscom stock, it's a quality growth stock. We're invested in management. We have strong strategic vision, record growth in fundamentals, and we're undervalued in China market terms, and that is relative to where we receive most of our revenue. the Chinese market, the valuation of the company is significant below what would be expected in that environment. As you can see, it is tightly held, but there is an approximately 31% free float of shares. Looking at the perception and the evaluation, the objective evaluation of Uscom in terms of its performance and its relative value, Tim Borum, the respected business journalist, summed Uscom's status as getting an A+ for everything but its share price. And that's particularly based on our promising connection to China and our evolving penetration into other markets, as well as the developing telehealth and high home care usage that is being explored by Google, Microsoft, Apple, and of course Tencent and Huawei. So in summary, and before we get on to questions, it's been a record year for us, and $4.6 million of a record cash receipt, up 36%, is really positive for us. And it summarizes what's actually happened in the second half of the year. That's basically predominantly come from China. We now have 8 full-time employees in China, and that looks like expanding with the demand and the opportunities to grow the business in China. We are improving and increasing the number of our distributors, improving the support that we give them, and we are sharing global information and research materials as well as marketing materials. So we're starting to produce some efficiencies in our Sydney, Beijing, and Budapest offices. The milestone, of course, for the China's strong growth is that the IMF expects that China will rebound to a growth of somewhere near 9% next year. It will be 1 to 2% this year, rebounding to 9% next year. And we are ideally positioned to take advantage of that opportunity. We will be spending this year pushing forward with the Uscom 1A sales that we're currently focusing on, but also we're expecting the BP Plus and Spirosonic devices, and very soon the Venti test to be available in China, and that will also be fed into our expanding network of distributors through the Uscom China network. Importantly for this year, we had our first profitable half, and this is a milestone for the company because this profit wasn't created by cutting costs. This profit was created by growing revenue. And I often get asked the question about profitability and say, how quickly will we be profitable? My answer to that is I can make the company profitable tomorrow by cutting costs, but that affects the potential growth rate in future years. At the moment, I think we've got an optimal growth rate, and we are inevitably heading towards profitability. Of course, we also remain debt-free, which is powerful for bio companies. While being heavily focused on China and being grateful for the results, the strong results that have been delivered by China, we have spent a lot of time developing our European operations and have appointed a new full-time dealer coordinator salesperson in Europe who will work through Budapest and deliver all of our products throughout Europe. That was planned to be released or initiated in early January, but of course the events of the COVID really overtook that. And we're not entirely on hold, but we are moving only as quickly as the COVID recovery allows us to. The same sort of expansion was undertaken in the US, and we are finding that the US at the moment are on hold, and it is very difficult accessing decision makers in the US. Having said that, we have a strategy, we have a plan, and we are positioned well for when the US does emerge from the COVID, but it's not factored into our short-term revenues. The new product, we're incredibly excited about the Venti test. It's a market response to need, and that is many people have started making ventilators, and they all need ventilating calibration. And it's not a technology that you can just wake up in the morning and create. This comes from years of development, and it's based around the high quality sensors that we have in Hungary. Finally, the summary of our results and what's going on in the future is we are invested in the future. We have products and operations that we are expanding. We just set up our Uscom Singapore operations or regional office for setting up our Southeast Asia activities, and that will begin to be developed over the next 12 months. We recognise that Southeast Asia is an emerging powerhouse for us. It also is nearby to China, and it also supports and sustains our activities out of Europe, as our devices, the spirometry devices, will be exported directly into Southeast Asia. So the company's getting larger. We are strategically focused on multiple markets throughout the world. As a strategy, there are various ways of looking at that, but the way I look at it is we potentially can grow very quickly with those footprints. And at the moment, we're profitable, and our future looks incredibly positive. And those networks will be the foundations of distribution that will feed profit and revenue to us foreseeably. So in conclusion, 2020 was a year of record financial results with profit and cash flow positivity and rapid growth in the second half, following global restructure and Uscom China establishment. Investment in China and all major markets is planned to deliver continuing growth with new products to drive future revenues. We are establishing a company of global clinical, social and commercial importance. And of course, we're improving significantly investor value. Thanks very much for that. That gives you a little overview of where we are, what we've done and what we intend to do. And I'd be delighted to take any questions from the floor.
Thanks, Rob. Once again, for listeners, if anyone would like to submit a question, please type it into the panel available on your screen, and Rob will endeavour to answer as many of those as possible in the time we've got available. We had a few come through over email, so we'll start with those. Rob, there's been a sudden large increase in payments for administration and corporate costs in the June quarter 2020 in the quarterly cash flow statement. Has there actually been a large increase in administration costs in the June quarter, or are there other explanations, such as some of the foreign exchange gains and losses being included as part of this item?
Look, there's no secret that costs are increasing really rapidly. And certainly we, as I said before, it's cost us perhaps $500,000 a year to maintain our listing, and that number keeps getting higher and higher. We've now started to audit both in Hungary and in Beijing, so that contributes to administrative and corporate costs. We then need to put on internally the resources to actually manage the operations. If in fact we sort of double our revenue as we have in the last 2 or 3 years, then in theory you can expect a 20-30% increase in internal administration to manage those finances. So we run the operations as tightly as we can, but it's inevitable that being listed and in multiple jurisdictions, and with the establishment of new centres, administration and corporate costs will go up. And that's the issue about profitability, and that's where we have to head towards. You know, foreign exchange has cost us perhaps $200,000 or $300,000 in the last quarter, and we also had purchases of inventory, etc. So there are a number of things which impacted the final quarter, which didn't impact the third quarter.
Thanks, Rob. And following on from that, what sort of volatility or expectations are there for admin corporate costs moving forward?
Look, it's very difficult to anticipate, but we aren't excessive in our management, and that's for sure. What sort of volatility I expect with what we have at the moment, we are stably able to handle the operations in Hungary and the operations in Beijing and the operations in Sydney. Hopefully there will be some efficiencies that come out of that, but I don't think as a proportion of our operations, and considering that we're a publicly listed company, we're an inordinately admin heavy organisation. Keep in mind that we also have to do sort of financial audits, we do product audits, we do all kinds of administrative work that may not be apparent to people who are not within the company. We do 4 audits a year now, and the same for products. We in Europe, we're in China, we're in the USA, we're in Australia, and we have product audits, manufacturing audits, all those locations, and it's expensive. There is no way around that.
Thanks, Rob. The next question is, given the Q4 briefing mentioned a growth trend and strong Q4 orders, how is the drop of 50% quarter on quarter explained? What in particular happened from the time of the Q4 briefing that hadn't been anticipated and affected Q4 sales? And also, what is the strategy going forward if the current global pandemic conditions were to continue?
Look, I think we should predicate that response, Matt, on it's difficult and volatile times. And at that particular time, that was in China. And what happened is the last week, when we had the final briefing, the last week, we had a number of orders come through that were emergency orders for COVID locations in China. And I'm unlikely to delay those sales so that we can get a nice stable trajectory of quarter on quarter growth. We took those opportunities and we took the revenue for, they fell in Q3. Sure, they may have come out of Q4. And so that sort of explains both the exceedingly strong Q3 and the less strong Q4 relatively. If those numbers, if those orders had fallen into Q4, we would have had a nice gradient between Q3 and Q4. I think in these environments and knowing what sort of business we have, sales will be lumpy. But I think really the important takeaway is not why one was a little bit bigger than the other and the other was a little bit smaller than the other, which is the sort of the apocalyptic vision of all of this. It's really to say the second half was profitable, cash flow positive, and had cash in hand. That's really where we want to get to. What we can also say is the second half in total was more than twice the first half. So there's a trend. And remember, the explanation for this is that Uscom China operated from the beginning of this year. So those 2 quarters reflect the increased restructure, increased commercial terms, improved commercial terms, the restructure of the operations and distribution in China. And despite the pandemic, we still ended up a long way in front of where we were. So I think rather than looking at the minutiae as to why and how one quarter was slightly different to the other, we can look at the numbers and say we're in a very good position relative to where we have ever been previously. It's been a record year for us. And there are orders still strong as China starts to recover. So looking forward, we're optimistic about that also. So I just noticed here the final part of that question. What's the strategy around going forward if the current global pandemic conditions were to continue? Well, I think we're partially insulated because our devices are relevant to infectious diseases. I think we haven't benefited yet from Europe and US sales because it's been such an emergency situation. Nobody's evaluating what the future of infectious disease medicine is going to look like in the US at the moment. They're just basically trying to deal with patients on a day-by-day basis. So the US market for us is difficult. Europe's starting to recover, and there are interests in expanding, and we are getting a developing pipeline, particularly related to our reorganised distribution approach and strategy in Europe. But it's still going to be slow. The IMF have predicted something like -5 or -6% GDP growth this year, while China's growing at, say, 2%, plus 2%. The US will be about -7.8%. Our focus is in the right place in terms of GDP growth. So I think we're doing the right things. We're focused on China, which is going to be the responding leader in recovery. We are developing Europe, and that will come along, is starting to respond now. And I think we're in the US and we're waiting to see what's going to happen. But we don't have a lot of cost in the US, so that's helpful. Most of our cost is in Australia in administration, and most of our opportunities in China. So that's the way I see us continuing, and that's our global response. There are many aspects of the pandemic that are totally unpredictable, and as such, I can't develop a strategy that will address the apocalyptic visions that some people have for this pandemic. We will all have to live on, and we will all have to do business. And Uscom's positioned very well for all of our technologies, both from a point of view of the technologies themselves and the role they'll play, as well as our focus on China and then Europe and then the US.
Thanks, Rob. And I'm going to sort of summarise the same question that's come in from a few different people, but the questions around level of sales growth, revenue, etc., that's expected in the new financial year. Can you give any sort of guidance on that?
Look, Matt, we've never traditionally given guidance because our numbers are relatively small. We're a relatively small company and growing quickly, which means that you can sporadically benefit from opportunity and then have a quiet period, and reading too much into those becomes counterproductive. I think really we've had the last 8 years of something like 30-35% growth. We currently have never been in a better position globally, and our recent results have never been better. We are now cash flow positive, and we have infrastructure and organisations throughout the world in our major markets. We have a string of patent protected technologies which are coming to market over the next 12 months. And we're about to release the VentiTest device, which is a solution to an immediate and critical need related to the current pandemic. So in terms of what we can expect from revenue, I would say we default to historical numbers and say we're growing at 36% per annum. We'll be introducing another 6 or 7 devices, plus the VentiTest technology over the next 12 months. But more importantly, we have the infrastructure and the distribution network that can now handle those new devices. So putting a precise number on it's difficult, but we've put in place the opportunities to grow revenue rapidly and substantially. And that's our ambition. That's what we're shifting to do.
Thanks, Rob. Next question was around gross margin and that it looked to be, and what it looked like on the half-year accounts. Is the number likely to be stable going forward?
Look, gross margin does fluctuate and varies for different products. We have some products which are capital-based products, and our margins always look as if they're substantial, and generally, historically, they vary between about 70, 75% and 90%. It depends on which products get sold. And remember that those numbers seem very high until you consider that regulatory may take 3 years. Development of the product may take another 3 to 5 years, and validation. So there is a lot of time and a lot of investment for each of our products. And sometimes I look and say that we now have 9 or 10 products on our books that all have incredible invested value that is about ready to convert to revenue. So the opportunity for us is really strong. Our margins are always good, as I said, somewhere between 75% and 90%, which is an absolute maximum. But we are looking to balance our prices internationally and spending a lot of time focusing on that as we open new operations in different jurisdictions. Some jurisdictions are stronger and wealthier, some are less so. So we try and keep a homogeneous or a standardized pricing, but that's always a challenge. And we'll be informed by the market. The market tell us what price is reasonable.
The next question is just around what percentage of revenue roughly is recurring in nature, and do you see this increasing over time?
Well, see, that's also part of what we did when we shifted from the Uscom device, which is a non-recurring revenue. Now we have some strategies about pay-per-use modifications to the software and the utilization. We also have some strategies about migrating the software to the cloud, and then again pay-per-use or subscription models for users. We're prepared to do whatever the market requests, but increasingly cloud-based options make most sense. But these are relatively simple modifications. What's really important now is not so much access to the cloud, which is basically a software connection, but it's really having front-end sensors. And these are sensors that provide high-fidelity core physiology measurements. And we have those in cardiovascular pulmonary, in Uscom, BP+, and Spirosonic technologies. So they can all be coupled to the cloud. They can all be coupled to apps. They can all be coupled to medical centers, telemetric health management. These are relatively minor steps. What's really important and what is the real value in medical devices are the medical devices themselves, because of the long development time, the long regulatory time and the high regulatory costs, and the complexity of the downstream iterations that require coupling to different software medical systems. We think we're in a very good position with that. And the best way to do that is with partners. And we are looking towards high quality partners in the telemetric health space. We're already partnering and working with some of the biggest technology companies in the world. And we are talking to some of the large players in China as well.
Thanks, Rob. Next one is, how do you think about the trade-off between cash flow break-even and revenue growth? I think you touched on this before, but if you just want to quickly again.
Look, as I said, Matt, I was asked from virtually day one, when will we be profitable? And my answer to that is we can be profitable quite easily if we cut costs and cut investment. But I don't think anybody's invested in Uscom to get a $5 dividend check each year. We really want to grow the company. We have ambitions to be $1 billion company, and we are pushing along those pathways. That's our target. That's our goal. That way, it's not going to happen by being profitable at $5 million revenue. It requires growth. We're going to have to spend, and we're going to have to push things forward. So far, we've balanced pretty well. We've reached now cash flow break even. that's the position where you want to be. Cash flow break even and growing rapidly. Growth is what the name of the game is, and never has growth been more important for investors. And I think the remaining reporting season will really emphasize how significant and how valuable our 36% revenue growth was. I think there will be a recalibration of expectations as COVID goes forward. And I think I'm really pleased where we are. Our future looks strong, and I foreseeably can see growth, even if the pandemic persists longer than any of us anticipate. I think we will be at the centre of what's going forward, and our markets, at least most of our markets, will stay strong and intact. So I think we're hedged for a lot of those unpredictable changes, but at the same time, growing strongly.
And the same person's asked, how has your competitive positioning changed in the last year?
Look, I assume you're meaning product competition. We still don't have a competitor for Uscom. We don't have a real competitor for BP Plus. Spirometry is only getting stronger as we develop our new Spirosonic Air, which is a totally wireless home care spirometer, digital ultrasound, and also as we develop the Venti test. These are technologies which are better than others with critical applications. And you cannot just create technologies like this overnight. For example, the Venti test basically is a result of technology that's being evolved for the last 7 or 8 years. Uscom's been technology that's evolved over 15 years, and BP Plus, almost the same, at least 10 to 15 years. So you cannot create these technologies overnight. You can copy them, but the algorithms and the software and the presentation of the devices actually takes a long time. It's almost a cultural thing that you have to put into your devices. And the Uscom story is about premium devices. We make the best devices. And interestingly, worldwide, the price you can command for premium devices remains high. You don't want to get into the copycat low fidelity technologies where you're basically selling pieces of plastic with a $20 board in them. A, the devices aren't reliable, and B, there's no margin in them. So you've got to build a strong company with strong technologies that preserves margin and adds clinical value. And really, at the end of the day, it's a very simple equation. You add clinical value, you save lives, you're valuable. And that value will return to shareholders.
The next question is from Peter, asking, just wondering how the Venti test stacks up against existing ventilator calibration options, and also how is the pipeline in China for Uscom 1A devices in the wake of coronavirus?
Well, ventilator calibration, there are a number of different methods. There are thermopile, there are differential pressure methods. I think it's generally accepted that digital ultrasound is the optimal method for measuring flow. It's a low resistance method. It's easy to clean, and remember, when you're breathing out in and out, and particularly if you've got infected lungs, you don't want to be catching any expelled foreign materials, which is what all the other materials have. There is a real risk of transmission of infection, particularly say for COVID, where a lot of these people will be being used. So the Uscom solution, which is based on digital ultrasound, is the only one of its type. Digital ultrasound, we know, measures flow to within 2.5%. So it's the highest fidelity method of measuring flow. It's the easiest to clean, and it's the lowest resistance, which means that it's the most accurate means of calibrating. And it will probably be about the same price as the other technologies. We're still working on the pricing yet, and we're finishing the final testing on it. It'll be a very valuable device for a very reasonable price, and we should be able to get it to market both in China, Europe, and the US in a relatively short period of time. Sorry, what was the second part of the question, Matt?
Just regarding the uptake in the demand for devices in the pipeline, the 1A devices in China post-coronavirus or in the wake of coronavirus.
Look, we're doing our best to stay directly across this, and Teresa Guo, our director of China operations and our global director of Uscom operations, is working very hard with our dealers to stay on top of the demand. And as far as we can see, we're predicting growth for this year, continuing growth, probably increased growth, because Teresa and her team are appointing new dealers in new territories, and our current dealers are performing relatively well, you know, throughout the system. And as China recovers, they are looking much more closely at means of establishing high quality infectious diseases centres. And remember that it was Uscom that was approved by the National Health and Medical Commission of China, People's Republic of China, as the preferred method to manage severe COVID cases. So we will be a part of the expansion and refurbishment of infectious disease centres in China, and probably in Europe and the US as well.
Thanks for that. Next question is from Reese. He asked, can you give us some information on how distribution agreements arise, and possibly if that's a strategy Uscom's pursuing? And has specifically asked about any information on the agreement with the Japanese distributor A&D.
Look, our distribution agreements, you know, distribution worldwide is variable, is the answer. You've got massive distributors that have huge reach, and you have little power, and so your pricing's diminished, but your volumes are high. And it's always a trade-off with small companies. At what point do you sell your soul? We do a significant amount of our work direct. So we've got internal people who actually communicate and sell directly, particularly say in China, but also in Australia and in Europe. And then you've got small dealers, and these are people who have particularly good connections, say in hospitals and towns, say, and they will have connections and they can sell, and they look for products all the time. So there's a different structured agreement with those people. There's a different structured agreement and sales pricing for direct sales. Then you've got intermediate, what would you call them, dealers, if you like, or distributors who service dealers, and that's another layer of complexity. So you've got one distributor who runs a number of dealers, and that again is a different distribution agreement. But then you've got the people like you know, the really big companies, say like GE, etc., and the relationship that you have with those is very much different. You have very little control about that, and your chances of growing and taking a significant portion of the profit are small. So we have a mixed strategy, if you like. You've got to be opportunistic, and you do need revenue and you do need turnover, but at the same time you also need profit. So to preserve your pricing, you need to work with those people who you see match your both needs and are comfortable being able to sell the profit and sell the products and make profit for themselves. So distribution is definitely the key to the strength of businesses in our domain, and having access to the market and building a global distribution network as we're doing now has incredible value, because what that allows us to do is to feed new products into that distribution network straight off. It also allows us to distribute for other products, or to acquire companies that have products that we can feed into our dealer network, because the real value add for medical device products is at that front end. That's where you take cash, you make profit. Selling devices is what it's all about. And that's ultimately where shareholders get their value. And that's where we're spending a lot of, it's what Budapest is about, it's what Los Angeles is about. We want to have an access to all of those markets directly and with our hands on them. And that's what we've been doing for the last year. So far, we've only been successful in China, but the same model that Teresa's been implementing in China will now be shifted across to these other territories. And that's very exciting if we can replicate even a fraction of the results that we have potentially ahead of us for China.
Thanks, Rob. The next question is just around what proportion of sales is accounted for by each device.
Look, at the moment, it's probably about 75% Uscom 1A, and that's because of our strength in China. Probably about 20%, 15 to 20% of BP Plus, and that's principally in Europe to established dealers, and that's undergoing reform at the moment. And the other 5 to 10% will be BP Plus. And we've really only been selling BP Plus so far into research environments. And we are hoping now that the A&D module and firmware is installed in the devices to take a much more active role in marketing that technology. We also released the BP Plus Reporter, which is a very innovative software analytics system for the BP Plus, and will prove its value in a variety of both research, clinical and home care positions. And it will be a delight to sort of finally activate sales into dealers and distributors worldwide for the BP Plus as those approvals come through. They are getting very close in China. They're in process in the US, and the Europe only requires some updates to the files before we'll be able to sell those as well.
Just got a few to go. There were still questions coming in, but just conscious of time, and we'll come back to anyone on email. Another question was, there's been an abundance of capital raising in the market, given the global environment. Can you give us an update on the potential for dilution in the coming financial year?
Look, we've got cash on hand, and it might have gone down a little in the last quarter, but for the year we've gone up. While ever you've got profitability and cash flow positivity, it's not a central focus. However, being a small biotech, being aware of the pandemic and the possibility of all sorts of things going wrong, you can never say never. I'm also very cautious about dilution. I'm a shareholder myself, and I understand the sensitivities that shareholders have about capital raising. I only capital raise if I think it's necessary, and it offers ultimately better value to the company. At this stage, there's nothing foreseeable that would indicate that if we achieve the results that we anticipate, that we would need to raise capital. I think at the moment, if you want Uscom shares, you should go and market and buy them. We don't have plans to raise capital. But as I say, you never say never in this world, particularly as precarious as it is at the moment. I think that's a fair observation.
And next question's from Ed, just asking, and not sure if this is one you're going to be able to give a lot of guidance on, but what was the level of receivables at the end of the financial year?
I actually don't know. We're in a pretty good position, and it's largely due to the financial model that's been adopted by Uscom China, and it's a very much, it's not exactly COD, but it's very close to. There's not a lot of outstandings. Most of our trade, we have virtually no bad debts, and most of our trade is at maximum 60 days, some at 30, but most deposit and delivery.
And we'll make this the last one, Rob, which was just given the current difficult government relationship developing in China. Do you see that as a risky thing for Uscom?
Look, politics is politics. They'll come and they'll go. I think, my personal opinion is I'm not quite sure why we show such an alliance to a partner who purchases 3.8% of our exports at the expense of another one that buys 38 or 39% of our exports. I think it's really responsible in terms of preserving and developing Australian business if politicians sort of take a fairly independent and pragmatic viewpoint about the world. And I'm aware of the current, what would you call it, sensitivities, but at the same time, we all need to do business, whether it's Australia or China or the US. And what we can see is that the more you disturb those relationships, the worse things get for everybody. As far as I'm concerned, we have got a Chinese team, we've got a wholly owned subsidiary, we are invested in China, we have good connections in China, we have investors from China in Uscom, and I don't see any direct fallout from or complications from those things. This is a blister and it will heal when politicians leave power. There'll be another sort of political format, but I think underneath that, global welfare depends on us all trading and doing business together and establishing some platform for prosperity for everybody. And my position at the moment is China's a strong economy. We work there, we contribute there, the same as we do in Europe and in the US. We trade and we deliver our products and save people's lives. It makes no difference to us which lives we save. That's an important time though, and I'd prefer to be well connected in China at the moment than not. I think politics can sort of overwhelm all this stuff sometimes.
Thanks, Rob. If you just want to give any concluding remarks and we'll wrap it up.
Well, thanks everybody for taking such interest. It's been a pretty exciting time for us as a company, particularly as we've had validation of the restructure. We spent a lot of time, and Teresa Guo, who's now our global head of operations, developing a strategy to restructure China. And it took us 6 or 8 months to implement that. But the validation of that was in the results for the second half. And as I said, the results for the second half were twice those of the first half and equal to the full year from the year before. So I think we're on the right track. We're doing the right thing. We've got new products. We've got a new and expanded network of distributors that's growing quite quickly. We have moved from China, taking the same model that we've been doing in China, and we're about to, or have been in the process of slowly implementing that in Europe and in the US. This has been delayed by the pandemic. We've got new products that are coming into the marketplace, and we're hoping that the benefits of the restructure to distribution will yield outcomes quite rapidly because of that expanded distribution. We're making ourselves bigger and stronger. A lot of these things are actually not evident on the balance sheet, but it's investor value that will underwrite growth and prosperity for shareholders foreseeably. And that's really been our objective. So thanks very much for both supporting the company and attending today for this update. It's been a great set of results for us, and we look forward to the year ahead.
Thanks. That concludes the presentation for today, and everyone can now disconnect. Thank you.